Welcome to Capital and Crypto. We talk about money, tech, and financial freedom every week. If you are a crypto beginner, this video is for you. We're going to talk about the 5 crypto trading strategies that every trader needs to know. With a number of cryptocurrencies still entering the market today, interest in trading the asset is high as ever. Let's get started. The strategies we're going to be covering in this video, including moving average crossovers, relative strength index, event-driven trading, scalping, and dollar cost averaging. Before we dive into the strategies, you need to know that cryptocurrencies are traded on decentralized markets, meaning that they aren't issued or supported by a central authority like a government or bank, and they're run across the network of computers, which is called a blockchain. Due to the decentralized nature of this cryptocurrency, they are free from many of the political and economic concerns affecting traditional currencies. However, this doesn't mean that cryptocurrencies are free from external factors. To the contrary, cryptocurrencies are unpredictable and are affected by factors like supply and demand, media presence, integration of e-commerce payment systems, and key events. These factors make it important that your cryptocurrency trading strategies not only focus on a way to navigate volatility, but to focus on diversification of your portfolio. Trading a wide variety of asset classes, including cryptocurrencies, allows you to diversify your portfolio. By solely trading one asset class or market, you're confining yourself to the conditions of one market out of thousands. By diversifying the types of trades you make, you can hedge against the risk of a market moving against you, as well as gaining the benefits of positive movements. The first strategy is called moving average crossovers, or MA. Let's start at the beginning. A moving average is a lagging technical indicator combining the price points of a financial instrument over a specific timeline, dividing by the number of data points to give you a single trend line. This single trend line allows you to determine the direction of the current trend while lessening the impact of random price spikes. It also enables you to examine the levels of support and resistance through analyzing previous price movements. So how do you incorporate this indicator into your cryptocurrency strategy? One of the main methods of utilizing the moving average is called crossovers. A price crossover or crossover is when the price of the asset crosses above or below an MA to signal a potential change in trend. To trade a moving average crossover in cryptocurrency markets, you will need to wait for the price crossover before you go long or short on the cryptocurrency in question. Another strategy applicable is to apply 2 moving averages to a chart, one short-term and one long-term. So when the shorter MA crosses above the longer MA, this shows the trend is shifting up and is known as a golden cross, which can be considered a buy signal. When the shorter MA crosses below the longer MA, this indicates the trend is shifting down and is known as a death cross. The second strategy is called relative strength index, or RSI. The RSI is a technical indicator, which is used to identify momentum, overbought, and oversold market conditions. It can also be used to highlight signals of divergence and hidden divergence in the financial markets. This type of trading is also known as trend trading. The RSI is calculated using the formula as follows. The indicator is depicted as a percentage out of 100, with a lower percentage typically indicating an oversold position and a higher percentage reflecting an overbought position. So what's the best crypto strategy for trading RSI? Well, that depends on your risk appetite and trading style. The RSI can be used for trading both short and long signals when the price is range-bound in nature as well. However, as markets regularly move in trends, using an RSI indicator to highlight trends for entry and trends for exit will give you an idea of when to engage. The third strategy is called event-driven trading. A strong media presence of a specific coin or crypto exchange can impact cryptocurrency markets. This cryptocurrency trading strategy focuses solely on taking advantage of these events. It's a popular trading strategy for those new to trading. News coverage of current events can influence the prices of many things like forex, pairs, stock, indices, and commodities, not just cryptocurrencies. This influence is not just speculation. Many experienced traders will take advantage of this. You'd normally wait until the market shows a consolidation pattern before an expected news release, like an earnings report, and then act as soon as a market breakout occurs. Yet, due to the volatile and unpredictable nature of cryptocurrencies, you may have to wait until after such a news release is published before engaging in the trade. Simply put, you'd buy your chosen cryptocurrency when positive news is announced and short it when negative news comes out. The next strategy is called scalping. Scalping is the practice of opening positions in line with a trend, often entering and exiting the market multiple times in a short period as it develops. Individual trades are held for just a few seconds, minutes at the most, so it is one of the most short-term strategies. This trading strategy works very well for active day traders. Scalping focuses on minute-to-minute price changes, which are driven by quantity. As soon as the trade becomes profitable, you'd exit the trade. There's no waiting for the market to depict trends, as you have to be quick and close trades that are losing money instantly. The more volatile the market, the better it is to employ scalping. Bear in mind that scalping can be risky if you are placing multiple trades on a very short-term basis. It's essential to manage your risk carefully. The last strategy we're going to cover is dollar cost averaging. If you're looking for a crypto trading strategy that doesn't involve indicators, then dollar cost averaging might interest you. DCA is a popular strategy for both beginners and experts. Instead of investing all your money into a specific asset at once, you divide your investments into smaller amounts. These amounts are then spread out over a predetermined timeline and are regularly invested on a particular time and day of the week, and only on that day and time. What does this look like? Let's say you decide you'd like to invest in Bitcoin. You've set aside $1,000 for this purpose and decide a DCA strategy will be the best way forward. So you would just divide your initial amount by the number of weeks you'd like this strategy to run for. For the purpose of this example, we'll say that you'd like to invest your $1,000 over 5 months. You would divide the initial amount by 20 weeks. That is 4 times 5 months, giving you 20 weeks, giving you $50 per week. For the next 5 months, every Tuesday at 2 p.m., you invest your $50 into Bitcoin until your initial amount is depleted. Why invest like this? Buying an asset in regular intervals helps alleviate the impact of market volatility, meaning you would typically receive more of the currency from your final investment than if you'd invest all your money at once. It's important to note, to fully make use of this strategy, you need to trade the specific coin through an exchange and not through a broker. Now you know the basics of cryptocurrency trading strategies, but how do you get started? The first step is always to open an account with an exchange or with a bank. And number 2, you have to learn how the cryptocurrency market works and choose a coin to focus on. With so many options, remember the importance of diversifying your crypto portfolio is very important. And number 3, building a trading plan from the above-mentioned strategies. Choose one which aligns with your personality and risk appetite. And number 4, open, monitor, and close your first position. Or you can open a demo account to practice your cryptocurrency trading strategies with virtual funds first. So hope you have learned some basic trading strategies today. If you learned something today, smash that like button, subscribe to our channel, and hit the bell for weekly financial wisdom.